Welcome back to the Deep Dive. This is the show where we try to cut through the noise, through all the jargon, to get to what really drives the financial world.
And today we are heading straight into, well, what you might call the engine room.
That's a great way to put it. We're taking a really deep look into a world that's incredibly powerful, often misunderstood, and frankly, the source of some of the most spectacular stories in finance.
We're talking about derivatives.
Exactly. The world of derivative.
And, when you just look at the raw numbers, the scale it's just hard to get your head around.
It's staggering.
Our sources point out that this market, this whole ecosystem, has seen just explosive exponential growth over the last, say, 40 years. This isn't some niche corner of finance anymore.
No, not at all. And that's really the starting point for you, the listener. You have to understand that derivatives aren't just these obscure things traders use on a screen.
They're everywhere.
They are absolutely everywhere. They are critical parts of corporate bonds. You'll find them baked into executive compensation plans at huge companies.
And maybe most importantly, they're the primary tools used to transfer risk. Think about mortgages. That risk is packaged up and moved around the globe using derivative structures.
So they're underpinning the stability, or as we've seen, the instability of the entire system.
Absolutely. And that brings us to the public perception, right? Because when the news covers derivatives, it's almost always about some spectacular, eye-watering loss.
A rogue trader, a massive bank failure.
A systemic crisis. And all that reporting just reinforces this popular myth, this idea that derivatives are just a form of, high-stakes gambling.
Okay, let's tackle that myth head on. If the common story is all about risk and gambling, what's the reality? What is the actual functional purpose of a derivative?
At their very core, derivatives are tools. They are mechanisms for risk transfer and risk management. That's it.
So moving risk from someone who doesn't want it to someone who does.
To someone who is, crucially, better positioned to handle that risk, or is simply more willing to bear it, probably in exchange for some potential return.
Give me a simple example.
Okay, say you're a U.S. company that sells products in Europe.
Yeah.
You're getting paid in euros, but your costs are in dollars. You are now exposed to the euro-dollar exchange rate fluctuating.
Right. If the euro weakens, I lose money.
Exactly. You would probably be very happy to pay a small fee, a premium, to eliminate that currency risk entirely.
And who do I transfer it to?
You transfer it to a massive investment bank that manages hundreds of different currency risks all at once. For them, your specific risk is just one small piece of a giant diversified portfolio.
Makes sense. So our mission for you today is to move past those scary headlines. We want to lay out the foundational concepts so you, as an intermediate investor, can really understand this world.
We're going to look at the architecture, where these things are actually traded.
The products themselves, the players involved, and finally some really critical lessons from some of the biggest historical failures.
And that architecture piece is the perfect place to start. Because where and how a derivative trades tells you almost everything you need to know about its risks and its flexibility.
Right. We've basically got a tale of two markets here. You have the exchange-traded derivatives, or ETDs.
And then the over-the-counter, OTC, markets.
I always think of it like this. The exchange is like buying something standard off the shelf at a huge retail store.
Okay.
And the OTC market is like going to a bespoke tailor and having something made just for you, to your exact specifications.
That is an excellent analogy. It really captures that fundamental trade-off between standardization and customization and the risk that comes with it.
So let's start with the retail store, the exchange-traded stuff.
Right. So ETDs, things like most futures and options you hear about, they rely on extreme standardization.
Everything is identical.
Perfectly identical. If you trade a corn contract on the CME, the Chicago Mercantile Exchange, it is precisely 5,000 bushels. It has fixed maturity dates, specified delivery terms, a set quality.
And that standardization is what allows it to be traded openly on a central platform with total transparency.
It's the only way it could work. And that standardization is also the key to how they deal with the biggest risk in any transaction.
Credit risk. The risk that the other person won't pay up.
Exactly. And this is where the genius of the exchange-traded market really lies. The innovation is the exchange clearinghouse.
Sometimes called a central counterparty, or CCP.
Yes. The CCP legally inserts itself between the buyer and the seller for every single trade. So if I buy a contract from you, the CCP becomes my seller, and at the same time, it becomes your buyer.
So you're not exposed to me anymore, and I'm not exposed to you.
Correct. If you were to default and just disappear, I don't care. The CCP is legally obligated to honor your side of the trade with me. It virtually eliminates what we call bilateral credit risk.
This seems like an unbelievable amount of risk for the CCP to take on. How on earth do they manage that?
They do it through two main pillars, two mechanical things that every single participant has to follow. First is something called initial margin.
Like a security deposit.
It's exactly like a security deposit. It's good faith collateral you have to put up when you first enter the trade. But the second part, this is really the critical innovation. It's called daily settlement.
Or, as it's famously known, marking to market.
Marking to market. And what that means is that profits and losses aren't just tallied up at the end of the contract's life. They're realized every single day.
Okay, so walk me through that.
At the end of every trading day, the clearinghouse looks at the closing price of your contract. If the market has moved against you, money's immediately taken out of your margin account.
And if it falls too low?
You get a margin call, you have to deposit more cash, called variation margin, to bring your account back up to the required level right away.
And if you don't?
They close you out. Your position is immediately liquidated to protect the clearinghouse and the rest of the market.
So what this does, effectively, is prevent a huge catastrophic loss from building up over weeks or months. It's managed every single day.
That's the key. You're constantly settling up. The contract is essentially repriced to zero every day. It's a brilliant system for managing short-term exposure. And those margin levels, by the way, they aren't static.
It change
Constantly. The clearinghouse is always analyzing the volatility of the underlying asset. If corn prices suddenly get very, very volatile, they'll demand higher margin deposits from everyone to ensure the system stays safe.
Now that's a sharp point for our listener. The CCP protects you from the other trader, but you're still exposed to the CCP itself, or maybe the clearing member, your broker, right? Zero risk isn't actually possible.
That's a very necessary distinction. You're right. Your risk is now concentrated with the clearing member and the CCP. If your clearing member bank fails, in theory, your assets are segregated and protected.
But in a huge crisis?
In a truly enormous systemic default, one that could wipe out the clearing member's capital and the entire guarantee fund, that's a pool of money all members contribute to, then yes, the system itself is stressed. The whole structure is designed for incredibly high confidence, but as you said, zero risk is a myth in finance.
It's just about layers of protection.
Exactly, layers that those old bilateral contracts never had.
Okay, so let's pivot to that other world, the over-the-counter market. The bespoke tailor.
Right, and this is where the truly massive numbers are. Our sources show the total notional value of OTC transactions is many, many times larger than the exchange market. Hundreds of trillions of dollars.
And what defines this market?
Customization, pure and simple. These are private bilateral contracts negotiated directly between two parties.
So a big bank and a big corporation.
Typically, yes, or a fund manager. And this allows for total flexibility. You can tailor the exact maturity date and non-standard size, a specific currency. You can embed complex triggers, anything you can agree on.
So if a huge multinational company needs a hedge that lines up perfectly with its fiscal quarter end, something you can't just buy off the shelf.
They go OTC. They call up a dealer bank and have a product built for them.
Which means the big challenge here must be
counterparty credit risk. Exactly. Historically, without a CCP in the middle, if your counterparty went bankrupt, you were just another creditor in line, exposed to the full loss of your potential gains.
I know this was a massive focus for regulators after the 2008 financial crisis.
It was. The big shift post-crisis was the mandatory introduction of CCPs for the most common standardized parts of the OTC market.
So things like standard interest rate swaps.
Exactly. Regulators forced those plain vanilla OTC trades to move into central clearing. So now, those OTC CCPs work a lot like the exchange clearinghouses. They require margin, they mark to market daily.
So it's transformed the market from a messy web of bilateral risk
into something a bit more organized, with centralized hubs to manage the risk for the most common products. But the really complex proprietary stuff that often remains bilateral, uncleared.
This whole discussion perfectly sets up the comparison between the two instruments that embody these two market structures.
Forwards and futures.
People often use these terms interchangeably, but they are worlds apart.
And our sources give us a really helpful 4-point framework to see the difference.
Let's walk through it. Point 1 is the contract type.
Simple. A forward is a private bilateral contract. A futures contract is traded on a public regulated exchange.
Point 2, standardization.
We've covered this. Futures are perfectly standardized. Forwards are not. They're customized.
Point 3, and this is maybe the most important mechanical difference, Settlement.
Crucial. A forward contract is settled only at the end of its life. The entire gain or loss is realized all at once, at maturity.
Whereas a futures contract.
It's settled daily. Mark to market. The cash flows in and out of your margin account every single day.
And finally, point 4, credit risk.
Futures contracts, because of the C3P and the margin system, have virtually no credit risk for the end user. Forwards, being bilateral, always carry some degree of counterparty credit risk.
So just by knowing that framework, you can immediately understand the basic risk profile of the instrument.
Exactly.
Okay, so we've got the markets. Let's look at the instruments themselves now, and we can divide them into 2 big families.
You have instruments that create a binding obligation.
And you have instruments that create a flexible right. Let's start with the obligations, futures and forwards.
A futures or a forward contract is a straightforward binding agreement. It says one party must buy and the other party must sell a specific asset at a set price on a set date.
It's a commitment for both sides.
Absolutely. The long position is obligated to buy. The short position is obligated to sell or deliver. No backing out.
So if I go long a September crude oil futures contract, when September comes, I am legally on the hook to buy that oil at the price I agreed to.
That's right. And the possibility of that physical delivery is what makes the whole system work.
How so?
Because it's the mechanism that forces the futures price and the spot price, the price for immediate delivery, to converge as you get closer to the contract's expiration date.
Because if they were way out of line, someone could just buy cheap in one market and sell expensive in the other for a risk-free profit.
The arbitrageurs would step in instantly and close that gap, but in reality, almost nobody takes physical delivery.
Right. The vast majority of these contracts are just closed out beforehand.
That's the reality of trading, yeah.
Yeah.
If you're long one contract, you just sell one identical contract before expiration. Your obligations cancel out, and you're left with either the cash profit or loss from the price change.
I remember reading a great story about this. I think it might be a bit of trading folklore, but it really highlights how rare delivery is.
Oh, I think I know the one you mean.
About the traders who sometimes just forget how the delivery process even works.
Yes. The classic story is about some young trader on a Wall Street desk who is long a contract for something perishable, like frozen orange juice or live cattle.
Right.
And he forgets to close out his position before the delivery period starts. Suddenly, his brokerage firm is on the phone asking, okay, where do you want the truckload of live cattle delivered?
It's a great image.
It is. It just shows how dominant the financial aspect is. The physical commodity almost fades into the background. But that threat of physical exchange is what keeps the market honest.
Let's talk about pricing patterns. If you look at a chart of futures prices for different months, March, June, September, you see these distinct curves. There are 2 key terms for this.
Right, and these terms tell you a lot about the market's underlying economic state. The first one is a normal market, which we also call contango.
Contango. Okay, what's that?
It's when the futures prices are higher the further out in time you go. So the 6-month price is higher than the 3-month price, which is higher than the spot price today.
And why does that happen? It
Yep.
seems intuitive.
It's because of the cost of carry. Think about it. To buy gold today and promise to deliver it in 6 months, you have costs. You have to finance the purchase, you have to pay for storage, for insurance.
All those costs get built into the future price.
Exactly. For most financial assets and non-perishable commodities, contango is the natural state of the world.
And the opposite.
The opposite is an inverted market, or backwardation. This is where futures prices decline with maturity. The front-month contract is actually more expensive than the far-out ones.
That seems weird. Why would something be cheaper in the future?
Backwardation usually signals that there's very high demand for the physical asset right now. There's a shortage, or a perception of a shortage.
Right.
This introduces a concept called convenience yield. If you're an oil refiner and you need crude oil today to keep your multi-billion-dollar plant from shutting down, you will pay a premium for immediate delivery. The benefit of having the oil now, the convenience yield, outweighs the normal cost of carry.
And for you, the investor, this stuff matters a lot, especially if you're looking at things like commodity ETFs.
This is a critical takeaway. If you own an ETF that tracks, say, oil, and the oil market is consistently in contango,
So future prices are always higher.
then the ETF has a problem. To maintain its position, it constantly has to sell the expiring, cheaper front-month contract and buy the new, more expensive next-month contract.
And that difference in price is a loss.
It's a constant drag on performance. It's called negative roll yield. You can be right that the spot price of oil is going to stay flat, but your ETF can still lose money month after month just from the cost of rolling those futures.
That's a huge trap for the unwary.
Yeah.
Okay, that covers the obligations. Let's move to the other family, the instruments that grant a flexible right.
Let's talk about options.
An option is defined by that lack of commitment. It gives the owner the right, but, and this is the key phrase, not the obligation.
To buy or sell an asset at a set price, the strike price, by a certain date.
And as soon as you hear right, not obligation, you get why these are so attractive for managing risk. There are two basic types.
The call option, which gives you the right to buy, and the put option, which gives you the right to sell.
Simple. I buy a call if I think the price is going up. I buy a put if I think the price is going down.
That's the basic idea. You'd only exercise your call option to buy if the market price, the spot price S, is higher than your fixed strike price K.
Because I can buy it cheap and sell it for a profit.
Exactly. And for a put option, you'd only exercise your right to sell if the spot price S is lower than your strike price K. You get to sell it for more than it's worth in the market.
We should also quickly mention the timing of exercise. They're those two terms that have nothing to do with geography.
Right, the historically confusing names. A European option can only be exercised on its expiration date, not a day before.
And an American option.
Can be exercised at any time up to and including the expiration date. It's more flexible.
And finally, let's give the listener a quick way to diagnose an option status. We have that terminology. In the money, out of the money, and at the money.
These terms just describe the option's intrinsic value. An option is in the money, or ITM, if exercising it right now would give you a positive cash flow.
So for a call, the stock price is above the strike price.
Right, S is greater than K. For a put, S is less than K. These options have real, tangible value already.
And if exercising it would be pointless.
That's out of the money, or OTM. For a call, the stock price is below the strike. For a put, it's above. These options are pure bets on future price movement, their all-time value, and they have a high chance of expiring worthless.
And the last one is easy.
At the money, ATM, is just when the spot price equals the strike price. S equals K.
Okay, that's a great breakdown of the instruments. So now we know the markets and the products, who is actually using them and why.
Right, the players. All of this massive activity really boils down to three distinct types of participants. And it's important to remember, a big firm can wear all three hats at once.
Let's start with the group that gives the whole market its economic reason for being, the hedgers.
The hedgers are the risk managers. Their whole goal is to transfer some existing risk they have from their business to reduce their potential for loss.
They want to replace an uncertain future price with a known fixed price.
They're trying to create certainty. A big airline, for example, they know they have to buy millions of gallons of jet fuel over the next year. The price of that fuel is incredibly volatile.
So they use futures or swaps to lock in their fuel costs today.
Exactly. It allows them to budget and operate without the constant fear that a spike in oil prices will destroy their profitability. They are fundamentally risk-averse.
Now, there's a classic academic debate here that we should probably touch on. It's the question of why the company should hedge at all.
Right. The argument goes, why doesn't the company just focus on making planes fly on time and let the shareholders hedge themselves if they're worried about oil prices?
Shareholders can diversify their own portfolios, after all.
It's a good argument in a perfect theoretical world, but it breaks down in reality. For one, there's information asymmetry.
Meaning the company management knows more than the shareholders.
Way more. They have precise information about their risks, not just fuel, but specific currency risks on specific contracts, interest rate risks on their debt. A shareholder can't possibly replicate that level of detailed hedging.
There's also a more cynical view, isn't there? That management sometimes hedges just to smooth out the quarterly earnings numbers.
To make their own performance look better and maybe maximize their bonuses.
Yes.
And look, that's a legitimate critique of how some hedging policies can be implemented. But even if that motive exists, the underlying goal of reducing the risk of real financial distress like going bankrupt because of an oil shock, that still benefits shareholders in the long run.
Plus, the company can do it cheaper.
Much cheaper. The transaction costs for a huge institutional hedge are tiny compared to what thousands of individual investors would pay to do it themselves.
So even with the best plan, a perfect hedge is almost impossible. And this brings us to a key concept for hedgers: basis risk.
Basis risk is what's left over after you hedge. A perfect hedge is only possible if the basis, which is just the spot price minus the futures price, was perfectly predictable.
And it never is.
It never is.
Yeah.
So the hedger trades their big volatile price risk for a smaller but still unpredictable basis risk. The risk is just in the potential change in that S minus F relationship.
And what causes that basis risk?
It's usually a mismatch, an asset mismatch, where you're hedging, say, high-grade jet fuel with a standard crude oil future. They're similar, but not identical.
Or a timing mismatch.
Right. Your futures contract expires in December, but you actually need the asset in mid-November. Or a liquidity mismatch, where you're using a series of short-term contracts to hedge a long-term exposure. All of these create uncertainty in the final basis.
Okay, that's the risk managers. Now for the risk takers. The speculators.
Speculators are the other side of the coin. They are pure risk takers. They are betting on the future direction of the market, hoping to profit. And they are absolutely essential.
Why essential?
Because they provide the liquidity. They're the ones willing to take on the risk that the hedgers are trying to get rid of. Without speculators, it would be much harder and more expensive for hedgers to find a counterparty.
For you, the investor, the big choice for speculating is between using futures and using options.
A night and day difference in risk. Futures offer enormous leverage. A small margin deposit controls a huge amount of the underlying asset. If you're right, the returns on your capital can be astronomical.
But the downside?
The downside is equally massive. The potential loss on a futures contract is theoretically unlimited. You can lose far more than your initial deposit.
Whereas options are different.
Options fundamentally change the risk profile. You still get leverage, but your loss is limited to the premium you paid for the option.
So if I buy a call option for $5,
The absolute most you can possibly lose is that $5. No margin calls, no catastrophic debt. That known limited downside is why options are so popular with speculators who want to carefully manage their risk.
okay, our last group, the market's sanitation crew.
The arbitragers.
They aren't betting on which way the market will go.
No, they're betting on consistency. Their goal is to lock in a guaranteed riskless profit by exploiting a temporary mispricing between two or more related instruments.
What's their real function? These opportunities seem like they'd last for milliseconds.
They do, and that's the point. The arbitrageurs are like the police force of market efficiency. By acting instantly with huge amounts of capital, they force prices back into alignment. They ensure the price of a stock index future doesn't drift away from the price of the actual stocks in the index.
And without them, the markets would be a mess.
Fragmented and inefficient. And it's worth noting, a big hedge fund will often be doing all three of these things at the same time, hedging its portfolio, speculating on a market view, and running arbitrage strategies.
All right, this theory is great, but we need to ground it. Let's walk through two detailed, practical examples. First, a hedge.
Let's do a classic short hedge for a commodity producer, and we'll really focus on how that basis risk plays out.
Okay, here's our scenario. We have a small wheat farmer in Kansas. It's December 1st. She expects to harvest and sell 5,000 bushels of wheat in exactly 5 months, on May 1st.
Let's look at the market prices on December 1st. The current spot price for wheat, what she could sell it for today, is $7 per bushel. The May wheat futures contract is trading at $7.15.
Okay, so she wants to lock in that $7.15 price. She executes a short hedge. She sells one May futures contract at $7.15.
Perfect. Now notice the initial basis. It's the spot price minus the futures price. $7 minus $7.15 is negative 15 cents. She swapped her big price risk for the smaller, unknown risk of what that basis will be in May.
Let's play out the first outcome. Prices fall. The hedge works as intended.
It's May 1st. The local spot price for wheat has dropped all the way to $6.50. The May futures price has also fallen to $6.55.
So she sells her actual physical wheat to the local grain elevator for $6.50, a much lower price. But she still has her futures position.
Right. She closes it out by doing the opposite of what she did originally. She buys back one May contract at $6.55.
And the profit on that futures trade.
It's the price she sold at minus the price she bought back at. $7.15 minus $6.55 is a 60-cent profit per bushel.
So her total effective price is the $6.50 she got for her wheat, plus the 60-cent profit from the future.
Which comes to $7.10 per bushel.
That's amazing.
Yeah.
The price fell by 50 cents, but she only ended up 5 cents below her original target.
And that 5 cents is the basis risk. The final basis was $6.50 minus $6.55, which is negative 5 cents. The basis changed from minus 15 to minus 5, a 10-cent shift. Her realized price, 710, is off from the original futures price of 715 by exactly that 10-cent shift in the basis.
She was almost perfectly protected. Now, what if prices rise? She misses out on the windfall, but should still get her stable price.
Let's see. It's May 1st, and the market has rallied. The spot price is now $7.80. The futures price is $7.85.
So she sells her physical wheat for a great price, $7.80, but now her futures hedge is a loser.
It is. She has to buy back that contract at $7.85 to close her position.
So her loss on the future is $7.15 minus $7.85, which is a 70-cent loss.
Correct. So what's her effective price? It's the $7.80 she got for the wheat minus the 70-cent loss on the future. $7.10.
Exactly the same price.
Wow.
Whether the price collapsed or skyrocketed, her hedging strategy delivered a stable, predictable price of $7.10. She gave up the potential for a huge gain, but in return, she completely eliminated the risk of a disastrous loss. That is effective risk management.
That makes it so clear. Okay, let's switch gears to the arbitrager. We need to look at mispricing. And this involves that cost of carry idea.
Right. We'll do a simple index arbitrage example. And the core principle here is that the fair futures price has to equal the spot price plus the net cost of financing the asset until the future date.
Let's break down the intuition first. If I'm going to buy the S&P 500 index today and hold it for 6 months, I have to borrow money, which costs me interest.
But you also earn income. The stocks in the index pay dividends.
So the futures price should reflect the spot price plus the interest cost minus the dividend income I receive. That's the net cost to carry.
If the actual futures price trading in the market is different from that calculated price, there's a risk-free profit to be made. Okay, let's run the numbers. The S&P 500 index today is at 4,000. The risk-free interest rate is 4%. The dividend yield on the index is 1%, and the futures contract expires in 6 months, so half a year.
The formula for the fair futures price, F star, is the spot price times E to the power of the net cost of carry rate times time.
Okay, the net cost of carry is the 4% interest rate minus the 1% dividend yield, so that's 3%.
Correct. We apply that 3% annual rate over half a year. So 0.03 times 0.5 is 0.015. That's our exponent.
So the fair price is 4,000 times e to the power of 0.015.
Which comes out to approximately $4,060.44. That's the theoretical fair price.
Now for the arbitrage. Let's say we look at the screen and the actual futures contract is trading at 4,100.
It's clearly overpriced. The market price is way higher than the cost to create it. So the strategy has to be sell the expensive thing and create the cheap thing.
So we sell the futures contract at 4,100.
And at the same exact moment, we synthetically create a long position. We borrow $4,000 at the risk-free rate, and we buy all the stocks in the S&P 500 index.
We hold that for 6 months. At the end, we deliver the stocks we bought to satisfy our short futures contract, and we pay back our loan.
Let's look at the cash flows. We get $4,100 from the future sale. We have to pay back our loan, which has grown to about $4,080.81. The dividend income we received exactly covers the difference between the pure interest cost and the net cost of carry we used in our fair value calculation.
So the riskless profit is the 4,100 we receive minus the effective cost of our position, which was the fair price of $4,016.44.
And that leaves a guaranteed risk-free profit of about $39.56 per contract, and it's armies of arbitrageurs doing this instantly that keeps these prices so efficient.
Okay, we've seen how these tools work when used correctly. But history is just full of stories where things go horribly, horribly wrong.
Right. And it's crucial to understand these are almost always failures of management, of control, of strategy, not a flaw in the derivative itself. It's like blaming a scalpel for bad surgery.
The tool is neutral. It's how it's used.
Exactly. And we can pull 5 universal lessons out of these famous disasters.
Let's start with failure mode number 1, separation of duties and the rogue trader. This is the classic story.
The poster child is Nick Leeson at Barings Bank in 1995. He was in Singapore, supposedly doing low-risk arbitrage, but secretly, he was making huge speculative bets on the direction of the Japanese stock market.
And the key failure was that he controlled everything.
Everything. He was the front office, the trader making the bets, and he was also the back office, the person responsible for settling the trades and accounting for them.
So he could hide his own losses.
He created a secret error account 888888, and just dumped all his massive losses in there, making the home office in London think everything was fine. A similar thing happened with John Resnack at Allied Irish Bank. The common thread is a catastrophic breakdown of internal controls.
The lesson here seems painfully obvious.
It is. Control and oversight. You must have a rigid separation of duties. The person who trades can never be the person who values or settles that trade, ever.
Failure mode 2, misunderstanding and exotic complexity. This is when people trade things they don't really understand.
You see this with Procter & Gamble and Gibson Greetings in the 90s. Their corporate treasuries were sold these highly exotic, highly complex, long-term interest rate derivatives by their banks.
These were custom-built OTC products.
Yes, and P&G was essentially speculating that interest rates would stay low. But buried in the fine print of these instruments were leveraged features that would cause losses to explode if rates went up.
Which they did.
They did. And the bigger problem was P&G didn't have the expertise to even price these things themselves. They were relying on the bank's proprietary models. When the market moved against them, they couldn't even challenge the valuation.
The lesson.
Knowledge is protection. Do not trade instruments you can't value independently. If you don't understand the worst-case scenario, you shouldn't be in the trade.
Okay, failure mode 3, liquidity and leverage in arbitrage. This one is about the famous collapse of long-term capital management, LTCM.
Right. A hedge fund run by Nobel Prize winners, the smartest guys in the room. They were doing arbitrage trades, but with enormous eye-watering amounts of leverage, maybe 25 to 1 or even more.
They were magnifying tiny little profits.
Exactly. Their models all assumed that historical relationships and correlations between asset prices would hold. But then in 1998, Russia defaulted on its debt. A huge, unpredictable shock.
And all the correlations broke down.
Completely. Everyone rushed for safety at the same time, a flight to quality. The markets became totally illiquid. LTCM couldn't close their positions. They faced massive margin calls, and their small, risk-free bets turned into a $4 billion black hole that threatened the whole financial system.
So their models didn't account for these extreme rare events.
The lesson is to respect tail risk. Those 5 sigma events that the models say should never happen, they happen. And when you combine that with extreme leverage, you're exposed not just to market risk, but to funding risk in a crisis, which is fatal.
Failure mode 4, strategy mismatch and basis risk. This is a case where the company tried to hedge, but got the strategy wrong.
This is Metallgesellschaft, a German company in 1994. They had long-term contracts to supply oil to customers at fixed prices, a legitimate business risk they needed to hedge.
So what did they do?
They used a stack-and-roll strategy. They hedged their long-term liability by constantly rolling over short-term futures contracts.
So they had a duration mismatch, that basis risk problem we talked about.
A massive one. The market flipped into backwardation, and they were hit with a double whammy. Huge losses on their short futures contracts, requiring huge margin calls, and the cost of rolling into new contracts became incredibly expensive. They were forced to liquidate, locking in a $1.3 billion loss.
The lesson here is about having a comprehensive policy.
Your hedging strategy has to match your underlying exposure, in duration, in asset type. An incomplete hedge can accidentally become a massive, unintended speculation.
Finally, failure mode 5, speculation in the guise of hedging. This is when the person in charge of safety starts gambling.
The classic case is Robert Citron, the treasurer for Orange County, California. He wasn't hedging the county's risks. He was using the county's investment pool to make massive leveraged bets that interest rates would stay low.
He was trying to outguess the market.
He was. And when the Fed started hiking rates aggressively in 1994, his bets collapsed. The county lost over $2 billion and was forced into bankruptcy.
What's the takeaway for any board or management team?
No outguessing the market. And the key defense against this is to mandate regular scenario analysis and stress tests. Ask the hard question. What happens if interest rates jump by 100 or 200 basis points? If the manager's answer is that'll never happen, that's your biggest red flag. That's human bias taking over.
That's a powerful set of lessons.
Yeah.
It's amazing how it always comes back to human behavior, not the financial instruments themselves.
Controls, humility, and a healthy respect for volatility.
Okay, that was an incredible amount of ground to cover. Let's do a quick 60-second recap for everyone listening.
All right. Derivatives are fundamentally tools for risk transfer, not just gambling. They trade in 2 main environments. Centralized exchanges, which means standardization and low credit risk.
And the over-the-counter or OTC market, which means customization and more complexity.
We have 2 main instrument families. Futures and forwards, which are binding obligations.
And options, calls, and puts, which are flexible rights that limit your potential loss.
The market is driven by 3 players: hedgers managing risk, speculators taking on risk, and arbitrageurs enforcing efficiency.
And the big disasters all teach us the same lessons. You absolutely need controls, You need to understand what you're trading, and you must stress test for the unexpected.
So we've covered the how and the who, but there is a huge question remaining for you, the investor.
And that is, how do we determine their fair value?
Right. We look at a screen and see a call option on a stock trading for exactly $15.60. Why that price? Why not 14 or 17? What's the logic?
The mechanics we've discussed today lead directly into the mathematics of valuation.
And that's where we're going next time on the deep dive. We're going to get into the core pricing principles, exploring foundational ideas like put-call parity, and the concept of risk-neutral valuation that allows us to find the correct price for these complex instruments.
It's the next logical step in your learning journey. Until then, keep digging.